Welcome back to the Markets with Mike. I'm here with investment advisor Michael McGlaughn, and we are going to dive into part two. So if you're just tuning in, we were talking about the recent big moves in the market. So Michael, is it even possible to plan for these types of curveballs in retirement, in your retirement strategy?
Well, yes and no. Yes, you can, and no, you can't. If you've waited until the curveball actually is thrown, it's a little bit late to plan for it. But getting ahead of it, and like we said in our last episode, the time to plan is now, and be proactive in it, then yes, you can do that. You know, we use kind of the fiscal house approach. We talk about the foundation, the walls, and the roof, and how your money is invested in those three levels of your house. If you plan ahead and you're proactive, then yes, you can be prepared for it. So it is possible to plan for it. You just can't wait until the last minute.
So if someone is moving toward retirement, should they be changing the way they're investing?
Well, again, that's an it depends, yes and no kind of question. You know, if you're just changing the way you're investing because you're reacting to how the market has performed, that's not necessarily a good thing.
Right.
It means one of two things. You're either reacting emotionally in a way that maybe you shouldn't react, or you're trying to time the market, which is not something that really works as an investment strategy. Or it means you were not allocated and invested and planned the way you should have. So, you know, if you are more risky than you should be based on your time horizon and your comfort level of risk, then yes, maybe we do need to look at changing the investment strategy. But if you're allocated right and you've got a plan in place, you shouldn't do it just to time the market because you're worried about a correction. So it's a it depends kind of answer.
Okay. The rise in the markets is good, but there's already been so much volatility this year. So what would you say to someone who's really concerned about all the up and down that we've seen so far?
Don't panic. Don't panic. That's the number one thing. Again, we've seen this in the nearly 17 years that I've been doing this. I've seen this many times in the market. Everything typically comes back. Again, if you've got a plan, you stick to it, you follow the fundamentals, you will end up being okay. But don't overreact. Don't panic. We want to talk about some more headlines?
Yes, if you just want to touch base on those for us, please.
We'll give a couple more here. So we talked a little bit last week about market performance and how the market had performed last week. The S&P 500 was up 1.2% last week. The NASDAQ gained 1.5%. You had some strong performance in tech and industrial sectors. And investors responded positively to the news on tariffs and trade relations with the U.S. and Europe. So showing a little bit of optimism there. The other kind of headline for us, analysts highlighted the importance of staying cautious, which is what we've kind of talked about a little bit here. Market volatility is probably going to hang around for a little while. So don't be surprised, even though we've had a little rally and a little bit of a relief, we may still have more to come. So
now we have some fun facts to share with y'all. So are you familiar with the cheese rolling competition that happens in England, Brockworth, England?
Not familiar with that.
I was not either. Yeah, I was not either. So apparently it is where runners take a plunge down a 200-yard steep hill in pursuit of a speeding wheel of cheese. I think the only way I'm running is if something's chasing me. I don't think I'm running after food. I love food.
So if we have the chocolate or the cheese chasing you,
then maybe I'll run. Yeah.
Are you a cereal eater?
Oh yes, who doesn't love cereal? As a kid, my favorite was the bunny Trix. Trix are for kids.
It's a Rice Krispie fan.
Oh,
chocolate Rice Krispies. Do you remember chocolate
I
Rice
remember
Krispies?
the chocolate Rice Krispies.
Those were good. I was a fan of those. Do you know what a box of cereal costs today?
It's expensive. I know that much.
$4.98 average for a box of cereal. 20 years ago, $1.99. And in 1975, it was 45 cents a box.
See, again, you said 20 years ago. My mom went to the 80s, not 2005.
Not 2005. I know. why we are talking about market volatility is so we can help impact inflation. And that's one of the 3 things that we do through our Bridge to Tomorrow process, which is making sure that we're tackling risks like inflation, taxes, healthcare costs. All of that continues to go up, and having a plan in place is very important to make sure you're managing that. Having strategies to protect your savings during a downturn, helping your nest egg stay stable, and making sure you're optimizing your gains when the market is strong,
Right.
are all 3 key components to how we work with our clients here at Trilogy. And waiting, as we said earlier, waiting to the last minute to make sure that you have a plan in place is too late. It's time to be proactive. So make sure you're getting out there. If that's something that you feel like you need to do, we're offering consultation, a free market volatility review for clients to come in, review where you're at today, and see if you're positioned the way you should be. There's no obligation to anyone to do that, other than just to come in, spend an hour of your time with us, let us take a look and see where things are, and help you with your strategy there.
Things are looking up as of now, but the good times don't last forever. So don't wait any longer. A way to really help you guide you through these highs and lows is to have a plan in place, and that is something that we would love to help you with here at Trilogy. So please visit our website, planwithtrilogy.com, or give us a call. Our number is 256-467-4382, and we will see y'all next time.